It's not every day that you get to see the tech giants like Apple, Amazon, and Meta making huge moves. But today, well, we had earnings. And well, this picture sums it up pretty well. You got Tim Cook with the fire background. You got Jeff Bezos out there on a yacht still somewhere. And then you got Mark Zuckerberg swimming in the cashola in the after market session. Seems like everybody's got their eye on the S&P 500 moving itself to 5,000, including these three. But guess what? We're not just here to talk about that. We're also here to reveal what others might be missing in this frenzy, which are these big moves in regional bank land going to force the Fed's hand? ... Again. So stick around on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intramarket analysis. Grab a drink, hang out, hit that thumbs up. Let's get into it. All right, people, welcome back. Just a quick reminder that down there in the pinned comment section, you can download today's chart check for absolutely free if you want to revisit these things. And there's information about the swing trading community, amongst other things. We're going to go ahead and start here looking at the chart of Apple in the aftermarket session, Amazon, and Meta. So these lines on the screen are what's known as expected moves. It's what the options market priced in as far as risk going into this earnings event. You can see Apple came down to tag its lower earnings expected move, is kind of bouncing from that level as it stands. Amazon was able to get outside of its earnings expected move and is floating just around that level. The big standout here was Meta. Meta broke through it with the fury and came into the 2 standard deviation move, but didn't stop there, people. It almost reached a 3 standard deviation move, which is incredibly rare to say the least. Apple stock falls because it showed a 13% decline in sales in China. Amazon reported better than expected results as revenue jumped 14%. And then Meta is doing its first ever dividend and authorized a $50 billion buyback. Ooh, Zuck. Now, if we take a look at the S&P 500 on the book map, there is interesting orders hanging around this level at 49.70, over 500 orders. So watch for this to potentially get filled and see how price responds in this area. This might happen in the aftermarket session or perhaps coming into tomorrow's trading day. We're going to start off by looking at some risks that are building, right? We all know that the mega cap names have been holding these markets together. But there are risks building around the system, and I think it's important to talk about them, and then we'll get into the indice charts and go from there to how to be more tactical. If we take a look at the Fed Watch tool, remember that the January meeting came and we held rates where they are. There's about a 61% probability that we're going to hold them where they are in March. The Fed said it was unlikely to see rate cuts, and they're going to continue to tighten until they see inflation come off and more towards their targets, and feeling more confident there. But there is question to believe, are the banks calling the bluff, or are they forcing the Fed's hand? If we take a look at the total assets here, the Fed balance sheet, we do see the continued tightening taking place on this recent report. If we take a look at the reserve balances, you can see here that it also kind of flattened out. And there has been a tight correlation between all of this. You might notice the difference here where this went up and this kind of went up, but it's kind of been flatlining. Well, the Bank Term Funding Program started last year and is set to end here in March. And you can see when it came into play after the Silicon Valley Bank blew up, we saw a huge move in the S&P 500, started to flatten out, and then we started to see another uptick. So one has to question this. Is this correlation going to end here in March? Because, well, apparently the program is going to be ending. And then is the reason why the S&P 500 trending so much nicer because the Fed stepped in here during that banking crisis? Well, I do have some interesting data to show as it stands right now. The KRE has been getting hit and hit pretty hard. Even today, it was down 3.12%. If we take a look at the top 10 holdings, you have CFG, TFC, Zion, RF, HBAN, MTB, Western Alliance, and so forth down the list. These are the top 10 in the regional banking, and we're starting to see a lot more volatility, very similar to how we saw Silicon Valley Bank blow up, and then the Fed stepped in with the Bank Term Funding Program, people, which was new. If you look at NYCB, which is the New York Community Bank Corp, you can see that we had another wicked down day today. Lots of volatility, down 11.13%, breaking below the low of the Silicon Valley Bank blow up low. So that's interesting. If you look at Western Alliance, we saw some massive volatility well off those lows there, but the volatility is slightly concerning. If we're going to see further downside in these regional banks like CFG, right? Big hit down there, almost 5%. Zion down 6.32%. And then you have a big flight to safety taking place, which was very similar to what we saw during the Silicon Valley Bank blowup. We saw a flight to safety in many different assets, and we saw obviously a lot of volatility in these banks. So while TLT is starting to rock for safety and reach for protection, duck and cover, some may call it, the 10-year yield is also falling, and you can see small body, larger body, getting some momentum there to the downside. When we get these strong moves, we can see snapbacks too as well, but nonetheless, this is something that has been concerning. And during this time, the dollar has been holding up rather well year to date and holding itself in rather defensive posture. This is despite seeing the S&P 500 and the Qs hold themselves together pretty well. In yesterday's video, we talked about the IWM hitting lower highs while the Dow Jones Industrial Average hits higher highs. So if you haven't seen that, go watch that. As far as the flight to safety goes, you can see that here in a relative strength graph. If you look at gold relative to SPY, utilities, consumer staples, TLT, and healthcare, you're starting to see these uptick a little bit here too as well to start the, just since a little bit there in mid-January. So that could be something to just pay attention to. Even today, consumer staples was the leading sector, up 2%. Let me just tell you, that's a pretty rare day for consumer staples. Then you have consumer discretionary and utilities up there too, which is a rate-sensitive name, and it's also more of a flight to safety. If you take a look at gold, gold is also a flight to safety type asset, and you're seeing a big gap up from here, and we've seen some strong days floating around the highs, and price action has been kind of consolidating here in this kind of flaggish pattern as it stands. Now, during this, we also still have a yield curve that continues to invert deeper, down 33 basis points of inversion, and the 10-year 3-month is 155 basis points inverted as it stands. There is going to come a time where it will be uninverted, and we'll show you what has happened in the past when it does that. But just note that, hey, even in March, right, when we were calling this out, this is not good for banks, and it took a while for something to happen, but over here in March, we had ourselves some bank blow-ups. Now, if we take a look here at the yield curve, the 10-year, 2-year, and the S&P 500 below us, what you'll notice here is when we got inverted, you'll notice that when it goes deeper into inversion, the S&P 500 has rallied. Deeper inversion, rallied, deeper inversion, rallied, and then deeper into inversion, it has been rallying. And then up until this point, it got a little interesting how this was actually kind of uninverting, but the S&P 500 went kind of sideways, and then we started inverting deeper, and we're seeing the market press itself still continuing to be higher. Now, if I zoom out and look at the 10-year 3-month dating back to the 80s, you can see we are deeply, deeply inverted. So much so, well, you don't see it this inverted since the 80s, right? And every time we got inverted, well, big things has happened. For example, the 2020 recession, the great financial crisis, the dot-com bust, and the 1990 recession there too as well. Now, the question here is the Fed done with the rate hikes? And when and how long are they going to hold them if that's the case? Well, this chart right here does suggest that the Fed is done hiking rates. What we're looking at is the federal funds rate in the federal funds effective rate in blue and the 2-year yield in red. And you'll notice here when the 2-year yield crosses down underneath the federal funds rate, it actually marks the time where we start to pause and shortly thereafter go into the rate cut cycle. So we went below it and then we paused and we started crossing. That was in 2008. This was in 2000, going into 2001, and we had the same thing happen here in 2018, 2019, where we crossed below it, and we paused, and we've been below it, and now we're talking about the pause, and now we're also mentioning the possibility of cuts, but the March rate cut, like Powell said yesterday, he sees it to be unlikely. Now, you might be saying, but Mike, we're at all-time highs. And I understand that. Well, if we look at times where we were this deeply inverted on a yield curve or getting to inversion, all these little pink lines are highlighting this was all around all-time highs in the market. These were all highlighting all-time highs in the market. And every time when we saw an all-time high, and despite that, where the Fed started cutting rates and the yield curve started uninverting, we started to see turbulence in the market. So are we going to see something similar? I don't have the answer for you, unfortunately. All we can do is look back to the left of our screen and see what has happened in the past. And we will get tactical by looking at the indices and show you kind of how I'm navigating it. But I want to also show you this specific chart with the IWM, the Russell 2000. The Russell 2000 has not made an all-time high, so this has been diverging from the main index products. But what I find interesting here is you can see a very, very clear picture. And I'll show you, this is IWM, this is the Fed funds rate, this is volatility of the Russell, and this is the 10-year 3-month yield curve inversion. And you'll notice when the Russell is going up like crazy, it's during times where the federal funds rate is practically at zero. Why? Well, because money is cheap and this doesn't encourage savings. When the federal funds rate is up higher or moving up, it encourages savings and less spending. And what you'll notice here is as we started to flatten out here and start to cut rates, you'll see price action starts to consolidate and get tighter, right? Price action coils up, it moves between expansion and contraction. And during that time, volatility did the same thing. You'll see over here too, as well, as we started to get into the rate cuts or start to pause, you can see volatility, or the IWM started to contract and volatility did the same thing. And as it stands right now, we are in an inverted yield curve, inverted, right? Multiple times I'm showing that. Price action's been going sideways, consolidating. You can look at volatility of the Russell and it's contracting. And then we're up here holding higher for longer, potentially moving into a time where we rate cut. Now, the reason why I'm bringing this up is because I don't think that, the Russell has to go down right here. It can very well press higher. But it is interesting to note that when we go into the rate cut cycle and when we uninvert, you typically get a spike in volatility, and the spike in volatility, that was 2009, this was 2020, right? This has marked the bottoms in the IWM. And then we go down into this zero rate environment, which forces the market up higher. So if we do get some sort of snapback and volatility fires off while the Fed's cutting rates and we uninvert, perhaps if we go back down to lower rates or we catch volatility, way up at a higher level, that could mark a potential buying opportunity for the Russell 2000. What can cause that? Potentially a credit event. Could be something with these banks. We don't know, and we can't really put on a trade right now because of it, but we at least can make ourselves aware of what's going on. Let's get into the indices and show you how to be a little bit more tactical in this environment. So we'll start with the SPY. The SPY is still in an uptrend and it's hanging around all-time highs. Yesterday on Powell's unlikely comments, we closed at around the low, but the bears could not do anything about it, and we had ourselves a nice little trend day to the upside as it stands, floating around those all-time highs, and we're still right there in that up channel, which we had discussed prior, right? If we're, as long as we're above the year to date and we're holding this channel and we're holding above the previous all-time high, all is well in SPY land. If we took a look at the 15-minute time frame, we said caution because we're below the 5-day moving average, but it was flattening out. Well, today, right, price action is looking, kind of tight here, right? So be aware of that. That's typically where we get pops to the upside. And the aftermarket session, we popped to the upside and we actually already hit the daily expected move, but we'll see how that plays out tomorrow. Going into tomorrow, we have the upper weekly expected move at 494. And we're back above, as it stands right now, above the 5-day moving average, which is actually bullish. So hopefully this starts turning back up and the trend there continues to the upside. When we need to be more careful is when price gets below it, but this starts to decline, right? If it's flat, that's not really a trend. If it's declining, that right there is more bearish, including when price is trending lower with it. If we take a look at some gamma exposure levels, a couple of videos ago, we talked about the market setting its sights higher. And by that, we meant that the gamma exposure levels started cranking up over there at 5,000. So that could be a key level to watch as traders look to bring price up into this level potentially. 49.50 is another key level. And then the gamma flip line is way down beneath there. Now, Gamma Lab that support this data, they did put an interesting note about CTAs. And I want to go ahead and read that really quick. They said that this main chart over here is showing CTAs and vol control funds. They said that they're completely maxed out and will not add to the length, but rather act as big suppliers in a bear scenario. So meaning that if price starts to come down, they can act as extra supply, which could create forceful moves. Now, the forceful moves would come more likely in negative gamma territory. That's where dealers look to sell into selling and they buy into buying. That's where you get more volatility there. They had mentioned a couple of levels here. They said, we believe CTAs will become sellers at 4,800 and will notably increase selling at about 4,750. And when I pull this up, that's actually quite a ways down there, but it was still an interesting note that we can revisit in the future if price does come down to those levels. If we take a look at the Qs is still in that uptrend, holding that quarter to day anchored VWAP here too. So perhaps after all these earnings and everything, we start to go even further and everyone gets so excited and we go retest the upper portion of this very pretty steep up channel. Then you take a look at IWM. IWM did crack the year-to-day anchored VWAP and the swing low, so that presents itself as cautionary. But right now we actually closed, from a pretty red day, and then we close at the high of the day. So if we can recoup these levels, that at least opens the door to potentially, this mean a little bit of a bear trap, and then we can go higher. It's if we get back below it, once again, proceed with caution. So you're getting some whipsaws in this area. But remember, if this does break down and it breaks down, ferociously, you don't want to catch this big move to the downside if you are long small cap stocks. So overall, just consolidating, saw a nice little day, but you want to see this back above it and get some confirmation. Now, going into tomorrow, an hour before the market opens up, we do have this non-farm payrolls and unemployment rate. These right here can create more volatility in the markets, so please be aware of that. And then at 7 a.m., that's Pacific Standard Time, 10 o'clock Eastern Standard Time, we have factory orders and Michigan consumer sentiment. You would think that these wouldn't do anything to the market, but the market has been responding quite heavily when these reports hit. So just be aware if you're trading intraday. Also going into tomorrow before the open, we have ExxonMobil, Chevron, Bristol-Myers Squibb, and some more names reporting earnings there after the bell. That's all I got for you on today's episode, everybody. Hope it helps out, and I'll see you later.